Good afternoon and welcome to Adelaide Capital's webinar with Surge Energy to discuss their tremendously impressive second quarter. Surge trades under the ticker symbol SGY on the TSX and ZTAF on the OTC. With us today, we have Paul Colborne, President and CEO, and Derek Christie, Senior VP of Geosciences. Congratulations on a record quarter. Surge has made amazing strides since the downturn of 2020 as a result of righting the ship to capture the upside move in commodity prices. Paul and Derek, welcome. I would like you to touch on the highlights of the quarter, your defined plan for free cash flow deployment, and the 2 new land packages you have purchased. There will also be some time for Q&A. Please enter them in the Q&A box or email me at jessica@adcap.ca. As always, the presentation may contain forward-looking statements. Welcome, guys.
Thanks, Jess. I'm just going to share our screen here.
Okay, well, thank you very much. We'll be kind of quick through the analysis of Q2. I'm Paul, the CEO. This is Derek, Senior VP of Geosciences. This presentation we have is short, so we won't even probably pound through the whole bit of it, but it's pretty short and it's fresh with the second quarter now being incorporated into this presentation. Surge just put out one of the best quarters of any oil company in all of Canada, any public oil company. Imagine a business if your cash flow from Q2 of last year was up 818% in Q2 of this year. That's right, 818%. And I've had several people forget about the timelines and they said, yeah, well, last year, Q2, that was the COVID crisis and oil hit $11. No. That was Q2 of 2020. Last year's Q2, oil averaged over $66 US a barrel, which is a pretty good price. So our cash flow is up 818% over that quarter, not the horrible 2020 crisis quarter. It's an unbelievable time for us, this latest quarter. It's up 389% cash flow per share over Q2 of last year. Now, we have a hedging loss. A bunch of banks made us put a fixed price oil hedges on that were around $65, $70 WTI. Those hedges have run out, but in Q2, there was the last quarter of most of those hedges. So we had like a 40 million hedge loss. The greatest quarter in Surge's history was 76 million of cash flow unhedged, and that was in Q3 of 2014. Unhedged cash flow in the latest quarter, Q2 of 2022, was $122 million. It's unbelievable, almost $500 million annualized. We restarted our dividend with a nice juicy 5% dividend yield. Now, it only is about 16-17% of Surge's free cash flow, equates to almost 5% dividend yield. So very low dividend payout ratio. Obviously, we could double, triple, quadruple the dividend. We wouldn't do that at any given time, but believe me, there's lots of room to move that dividend up. And Derek's going to walk you through. We've had some really exciting early drilling success and a couple fun crown sales, very exciting actually, in our 2 core areas, primary core areas in the Sparky and Southeast Saskatchewan. I think we ended up reporting early, but as the reports are coming in, I think it's pretty safe to say Surge has put out the best quarter, not in our company's history, that's a given, but in the industry. So yeah, with that, I'll just say that we're very excited about the quarter. The people on this call, what are you guys looking to do? Just like Jess does with me and Derek and other companies she looks at, you're doing your due diligence to decide who are the best companies to invest in. You've heard that crude's over $90 US, been as high as 120 recently, probably going higher. The market's incredibly tight. There's no oil. We need to reinvest more. So you're hearing that macro. That's great. What are the best companies? Who are they? Well, when you scratch the surface and dive deeper, you'll see Surge is the best company. And it's not because of me. I've done this 4 times for the most successful oil companies in Canada, StarTech, Crescent Point, Starpoint Energy Trust, and now Surge. And I've done it with 4 different teams. And I can tell you, it's not me. And it's not, unfortunately, Derek. It's asset quality. If you have elite, large oil in place, high quality, low risk, low cost conventional reservoirs, I turn them over to top guys like Derek and Murray By, our COO. I'm just a lawyer by trade. I turn them over to top technical guys. They get me a higher and higher and higher recovery factor over time. And these pools wildly outperform deep, expensive, tight rock that has steep declines, high costs, and don't water flood. That discipline is all it's about, sticking to the elite reservoirs in the best plays. And that's really what delivers why Surge has, there's two ways I know to value a company. One is free cash flow, or in our world, that's probably the new earnings is free cash flow. And the other way is net asset value. And we'll show you who has the best free cash flow yield in Canada. And one of the best net asset value stories, meaning we're trading at about less than half of our Sproul independent net asset value per share. Well, those are the two ways I know how to value the company. I kind of walked you through this. It's an amazing quarter. We've also, as I said, started our dividends. So now while we're all waiting for the summer doldrums to be over and Nancy Pelosi to come back to the US and not force oil prices down $9 in 2 days, which I don't have any on our trip. She's stopping in Taiwan, and somehow that's bad for oil. Our quarter summarized nicely here. I've already kind of done it, so we're going to dive into a couple of the key things. Derek's going to talk about drilling. There's the NAV I mentioned to you. One of two ways I know how to value a company, net asset value. This isn't Paul and Derek cooking the books and showing you guys on this sheet, oh, who's got a really good net asset value. This is after a 3-month every year grind with the top firm in North America, Sproul. We show them what we think. They say no. We show them what we think. They say no. We show them. It goes, often we've had as many as 7 iterations, but usually 3 or 4. And it's a grind. And we show them the value of our company. And at the end of the day, they say, that's all I'm giving you, or that's all that I'm showing you or going to give you. So after that normal annual grind that we always do with Sproul, they've said Surge's net asset value at $80 flat pricing for oil, price deck, your NAV is 24.43 cents a share. We agree. The chart on the right just shows, and we're trading at $9. So phenomenal value proposition. We put no land, no seismic, and no value for 1.3 billion of tax pools in the calculation either. You can see different price levels on the right-hand side, but it just shows the great value proposition in Surge at $24 a share net asset value. The other way to value a company, so that's one way. So there's part of your due diligence. And then what's the other way? Who's got the free cash flow yield? Which company has it? Eric Nuttall's firm, which is the top performing mutual fund in Canada for energy, 9 Point Partners, they say Surge has a 40% free cash flow yield. We agree. Now, that doesn't include the dividend we just put in. If you put it in, it'll be a little less. But another way he measures is your free cash flow is this chart. Both Vermilion and Crescent Point are much bigger companies. In our large, junior, small, intermediate space, Surge is the number one value proposition for free cash flow. In other words, we could buy our entire company, all the debt back and all the shares back in 3 years. So almost twice as good, 2.8 years, almost 50% better than the median. So it's a great way. And this is the chart I mentioned. Best free cash flow yield of our peer group. Some of these companies are way bigger or gassy, so they're not in our peer group. But it's Surge. And I only bring it up because those are the only two ways. And so you've got 2 pieces of due diligence, independent. They're not Paul and Derek, they're Sproul, and this is 9 Point Partners saying these things about Surge. So very nice independent research. The macro is unbelievable. It's never seen before. We're off the charts. You can see the biggest drawdown in the history of the world was last year, and now we're looking to be twice as big, meaning Joe Biden's pulling oil out of the strategic reserve, petroleum reserve in the U.S. at the fastest pace of all time, and he's going to be out of oil by late November, early December this year. He'll take it down as low as it's allowed to go. And it just seems like people aren't actually acknowledging, or to us, we think oil, you saw recently JP Morgan say oil could go to $280 a barrel here if people don't start drilling. We agree. But for now, Nancy Pelosi went to stop for a day in Taiwan and oil's down $9. Okay, somehow that's bad for oil, I guess. But the macro looks amazing. And it is not caused by Russia invading Ukraine. It's caused by 7 years of chronic underinvestment. We used to invest about 800 billion US a year as an industry. We got down to 300 billion during COVID. And I think this year we're set for about 450 billion spent. And we have record demand up to the right. It's demand inelastic. So unless we start drilling and putting on bigger projects, we think this is going to continue. And basically, I think we're in an oil crisis. There's no oil. What does well during inflationary and even stagflationary times? Energy. Great place to be. It's been proven after umpteen different recessions and then the subsequent even stagflationary times after those. So I'll just leave that with you as a general statement. This is our new corporate estimates. We haven't put out formal guidance approved by our board, but this is what we think we look like at 85 WTI next year. We're already into August, so everybody's starting to come out with 2023 numbers. So you can kind of see that free cash flow yield here. That's after our dividend. We'd use the 85 case. That's roughly where strip prices are next year, just under 85. So there's what I mentioned to you. So massive free cash flow for Surge Energy on these estimates for next year. I won't bore you too much, but in one quarter, we paid our debt down from 331 million to 275 million. So we're pretty thrilled about that. Plus, we also implemented our capital program. Plus, we also put in a dividend. So it's been a very exciting time for our company. Plus, in December of last year, we paid out all of the Canadian chartered banks who wanted out and brought in really stable, long-term term debt providers. Two big pension funds were the bulk of the 160 million of term debt we have, paid off all the banks. That's 5-year money on attractive terms. This was announced, Jess asked it as a bit of a question, but it was announced in our quarter. We made ours really simple until we're probably hit in sometime in late Q1, Q2 next year, we'll hit phase 2. But we started our base dividend. We could probably increase that by at least 50% and still be paying debt down. Out of 3/4 of every dollar is going to continue to go to debt payment. We already have a debt to cash flow that's really low. We want it even lower. So we'll probably enter phase 2 sometime in Q2 of next year. And then we'll increase the base dividend, or we'll have a special dividend. We'll start a share buyback program, and we'll continue to pay debt down. We're already sitting at a debt to cash flow of 0.5 times when the old good balance sheet was 1.5 to 2 times debt to your cash flow. And we're already looking to exit this year around 0.5 times debt to cash flow. But our goal is not to actually pay the debt right off, but get it down to a terminal debt level that's super low. This is key. I'm going to let Derek, I mentioned to you at the get-go, I bragged a lot about our asset quality. So Derek and myself better be able to back this up. This slide we created for business people like on this call. And all it's saying is, there's 2 slides. Derek's going to handle these, but all it's saying is 0.1 mil at RC tighter rock on the left, the extremely tight, very tight reservoirs. They wildly underperform the low-cost, shallow, conventional rock. And the rates of return and the profit to investment ratios PIRs go up through the roof if you're on the good side or the right side of this spectrum. This is where Surge is. I'm going to let Derek walk you through, and we tried to create something that's empirical to show you what this means to the 80 people on this call. What Paul's saying, and again, I'm just a lawyer, so I learned this over the years. What is Derek and Paul saying and trying to get through to you is the extreme high quality of our asset base is the real reason you should pick Surge over some really good peers we have. Derek?
So thanks, Paul. As Paul mentioned, we've really made a conscious effort to focus on that conventional part of the permeability spectrum. And then this slide really highlights the 2.7 billion barrels of oil in place that we own underneath our lands. Really important with that is that, referring to the reserve report that Paul talked about earlier for our net asset value, only 6.4% cum to date recovery factor is booked on that 2.7 billion barrels. 9.6%, sorry. 6.4 is the cum to date, 9.6 is the booked recovery factor. Then when I look at pools like this, what's the recovery factor we're going to see from pools like this? You see up to about 20% on a primary recovery factor basis. And then when you throw in water flood on top of that, it's about 30%. So really what we've shown is that we have that 2.7 billion, we have 6.4 that's come out of the ground to date, and then 9.6 is booked, but then we see a roadmap up to 30%. Then when you think of just these large oil in place pools, really they always tend to outperform that. So just a small change in recovery factor, so a 1% change on that 2.7 billion barrels is 27 million barrels of recoverable oil. Just to kind of put that into perspective, throw on a modest netback of $40. All of a sudden, that's an undiscounted value of $1 billion to Surge just for a 1% change in recovery factor. Also on this slide, we have...
And for perspective, what Derek just said to you, a 1% change is equal to $1 billion of undiscounted cash coming into Surge. Our entire company's market cap is $800 million. So 1% change would double the company's market cap. It shows that torquiness that we have in our asset base. And this all goes away if that column, if we didn't have 2.7 billion barrels of original oil in place, the whole argument would fall down. So it shows how important asset quality is in our opinion. Sorry.
That's okay, great. And then also on this slide, we have our total drilling location count. So as a company, we have more than 950 drilling locations. And then importantly, the 456 of those are booked in our independent reserve report. So that leaves about 500 unbooked locations, again, to add that extra value. Our two key plays that we really focus on are the Sparky and Southeast Saskatchewan, really offers exposure to two of the top 4 conventional oil plays in Canada. From a production basis, so that's 65% of our production comes from those two areas. And then importantly, 85% of our capital spend will be in those two areas in 2022. Really why? So people will ask me, why do we spend all of our money in those two plays? So this is some independent research that was done by Raymond James. So on the right-hand side here, they took all of the oil plays in Canada and they ranked them. And the criteria for ranking is when does a well reach a second payout? So you drill a well, you get your money back. When do you get your money back again? And then they ranked all the plays. So the top plays in Canada were our Sparky core area, Southeast Saskatchewan conventional, the Clearwater, and the Charlie Lake. So showing you that inventory that we have, not only do we have some exposure here, but really 2/3 of our drilling inventory is in these top two plays, and that's really where we're spending our money. Historically, Q2 is a bit of a slow time for us as we come out of breakup, so we generally do not drill that many wells. To date, in Q2 this year, we drilled 9 wells across our core areas, Sparky, Southeast Saskatchewan, and Valhalla. As we look for the back half of the year, we'll be drilling probably another 50 wells for the last Q3 and Q4, for the remaining Q3 and Q4, and that will be spread across both the Sparky and Southeast Saskatchewan. A little bit of detail around the Sparky here. So the Sparky is part of an 11 billion barrel oil trend. Surge really focuses in the light to medium gravity windows. So that's 4 billion of that 11 billion barrel trend. And we control about 1 billion barrels of oil in that trend. Something that's real key to this play is just the amount of vertical well control that we have. So there's 20,000 vertical wells that have been drilled and penetrated the Sparky. So we have that log data across here. Then we integrate that with 3D seismic over top of all of our pools, then some detailed reservoir engineering. We end up with a truly integrated reservoir model. What that does for us is that we've been able to drill 200 successful wells. And then more importantly, it actually helps to de-risk our future drilling. Other key parts about the Sparky, very low cost to drill out here, even with some added inflation that we've seen from Q1 into the balance of the year. We're at 1.6 million, that's drill, complete, equip, and tie in. So still great economics that we're seeing here. We've really grown this production from essentially 0 to 9,000 barrels a day through some strategic acquisitions and then drilling of those 200 wells that I mentioned earlier. And you can see in the middle there just where it ranks. It's these are the top plays in Canada. The Sparky is just behind the Charlie Lake there. Now moving into Southeast Saskatchewan, as I mentioned, that we We have been busy down here as well. So as we look into the back half of this year, we'll be adding a second drilling rig in September. So we'll have 2 drilling rigs running down here for the balance of the year. So we'll be really concentrating a lot of our activity here. As Jess alluded to, we have been very active in the last few quarters through some organic opportunities that we've seen. This is a really good example of those organic opportunities that we saw through some land sales. So we were able to pick up 46 top tier drilling locations in a very competitive Crown land sale. So very excited to add that to our inventory. And I think importantly, we'll be drilling 6 to 8 of those locations as part of this program. So we acquired that land and now we're going to actually be putting the bit to the ground right away on that. Some real important things in Southeast Saskatchewan, just the low cost of drilling here. So now we're just over $1 million to drill a well. Kind of one of the reasons for the lower drill costs here is that we do not need to frack these wells. So they're drilled open hole. Focusing on the Frobisher, we have a very strong active water drive here. So we get very strong primary recovery factors, north of 20%, sometimes up to 30% on a primary recovery factor basis. A couple other points with Southeast Saskatchewan. We did a couple great acquisitions last year that provided us with some of that inventory and also gave us that 5,000 barrels a day of production that we have down here. Then we've been really adding to that with our own organic opportunities that I mentioned earlier. So really, this has got a great runway for us. We have 8 years of drilling and really, really low capital efficiencies in line with the Sparky. So it's a great complement for us to have these 2 plays.
So the play that Derek just showed you, we added Southeast Saskatchewan. So imagine as an investor, you're drilling a well, you own the land, you drill the well, and the well pays out in 7 or 8 weeks. Then it pays out and you get 100% profit, probably inside of 1 year. And then it pays you another 100% profit inside of 2 years. So that's how lucrative and then it settles down and pays out several more times. So all I'm saying is it's ranked second in Canada, and we think we agree with it. And it's been one of the top plays in North America over the last 75 years. So when you combine that with the Sparky play that we showed you, there's one company, in Canada, that has a dominant operational position in 2 of the top 4 plays, Clearwater, Southeast Sask, Charlie Lake, and Sparky, as ranked by Raymond James. Surge. Only one company has a dominant operational position in 2 of the top 4 plays in the entire country. I think we're really good on ESG, but I think I did a really bad job of telling people about it until the last year. We're trying to highlight it now. We already abandoned 3-4 wells for every well we drill. So we're returning, 3 to 4 wells to nature for every well we're drilling, reducing our environmental footprint. We've got a diverse board. We added 3 female board members with great track records about 2-3 years ago. And we're trying to not just, talk to talk, but walk to walk. We filed the detailed ESG report last December to great acclaim. It's the detailed one. There's a few of our key points here, but I'm just letting you know, I think Surge is a leader in ESG, and we're trying to highlight that for investors like on this call. Last point I mentioned to you, we have the best free cash flow yield in Canada, as independently stated by the top firm in the country, 9 Point Partners, Eric Nuttall's firm. We have one of the best value propositions in terms of a lot of our peers are trading at or through their net asset value per share, which is fine. We're trading at $9 and our net asset value independently engineered by the top firm in Canada is $24, which I love. It means we're great value. There's 10 of the top analysts in Canada. So don't take my word or Derek's word. 10 of the top analysts in Canada, and we're raging by with all of them. I think the average target price is around $15. We have some targets as high as $16.50 a share. The beautiful thing is now we have a nice juicy dividend with a really, really low payout ratio. So you get paid while you wait, and not a 1 or 2% yield like some of our peers. We're pretty close to a 5% yield on a super low payout ratio. And it's quite exciting for us. I think Surge is the best story in the country. And to prove my point empirically, who's been, until this meltdown a few weeks ago, but who was the number one performer in the country between November and this year in terms of share price appreciation? Surge Energy. So the word's getting out, the story's getting out. Smart people like Jessica have done their due diligence and are bringing these stories to you. We're thrilled to be invited, and thanks, Jess, for the invite. Are there any questions? I know we've got some already mandated questions, but any questions from the floor before we start the kind of Q&A, Jess?
I'm going to start with mine, if you don't mind, because I just want to touch a little bit more on the macro. I mean, as we saw this morning, OPEC's only increasing production by 100,000 barrels a day, and a lot of that has to do with the fact that a lot of the OPEC members are not producing at capacity and can't. Venezuela production is down by 50%. We're in a very tight diesel situation, which is continuing. And then with the significant withdrawals in inventories that we've had, even if we are in a recession, which we technically are at this point, do you guys see any kind of demand destruction? I personally don't, given that we can't even meet basic energy needs at this point. But what will be your view?
It's a great question. We just had dinner last night with a guy who's based out of Switzerland, and he has a private investment fund that he invests for high net worth parties. And he said, absolutely see no demand destruction. In fact, just read this morning, we're at worldwide record coal usage, which is undoing all of the good benefits that the oil industry's made, the natural gas industry's made. We're now going to pound out a bunch of usage of coal, and we'll get painted with that brush, but we're not a coal company at Surge, and people will blame us. It's coming in the future. So I guess all I'm saying is crude is demand inelastic, meaning as the price goes up, it doesn't matter because it's a necessity. We need it to heat our homes, run our air conditioners in the summer, drive our cars, planes, trains, jets. Like it's so hilarious. So crude averaged 92 WTI for 5 years in a row before the downturn in 2014. And everyone said, oh, it'll wreck the economy. It's terrible. It's horrible. There'll be demand destruction. Demand for crude went up to the right every single year of that 5-year period. So all I'm saying is you've seen some people say, like JP Morgan and others, $280 a barrel. I'm not saying that, but I just think until we start drilling more companies that are not putting the money back in the ground, they're paying down debt, paying dividends, share buybacks. So no, I see zero demand destruction here. Maybe somewhere around $150 a barrel, I think you'll see people start to cut back. But in real dollars, you have to get to 100. Was JP Morgan or Morgan Stanley wrote just a few weeks ago, you have to get to $175 a barrel to be where crude was back in 2013, 14 highs in real dollars, because so basically people have had it too good for too long. They've had cheap energy, and the market doesn't recognize that. But good question.
Well, yeah, and your cost escalation was about 12%, if I'm correct. I think we're, and you don't have to frack your wells. You don't use as much steel. A lot of your wells are open hole. You're going to see higher cost escalation from a lot of other producers that drill bigger wells, bigger fracks, things like that. So that also does increase the base price for making crude economic, right? So, I mean, there's a lot of stuff that won't be drillable as the cost escalations are hitting a lot of guys pretty hard. I mean, we have a shortage of sand, we have shortage of crews, shortage, steel prices have gone through the roof. I mean, I've heard as high as 35%, 40% for some of the guys in the US and in Canada. So that also, helps put a floor on the price, I would say, at this point.
Yep, I agree. And we're lucky. And this is another positive for an investor looking at who to invest in. On top of all the other things I mentioned, we're pretty much shallow, conventional plains drillers. So if you're drilling deep, expensive Montney pads with 6 wells that cost $5, $6, $7 million per well on the pad, 25 to 30 million, if your costs go up 20, 25, 30%, that's massive for Surge. we're drilling our Sparky wells for $1 million. If it goes up another 10% more than we budgeted, that's $1.1 million, and the well pays out in 9 weeks, not 8 weeks. So we should be one of the least impacted by cost escalation here.
That's what, that was what I was trying to get at for sure.
Yeah.
And because I think that's starting to hit some of the valuations out there, as well as taxability, which is another thing with you guys. You have 1.1 billion in tax pools, 1.8.
1.3 billion, yeah.
1.3, sorry. 1.3 billion in tax pools. So, I mean, that's the other thing, that a lot of companies are facing taxability within the next year or so. And you've got a much longer runway to taxability, depending obviously on prices and how you distribute your free cash flow. So that's another thing that should give you a premium multiple. Just want to touch quickly on the A&D market. You guys have been active on land sales, etc. You've always historically been active on acquisitions. What are you seeing in the market right now? I mean, I know there's a lot of stuff for sale. Are you seeing sellers start to be more realistic in their pricing, or are they still up in the air and demanding higher?
Yeah, I think it's still fairly wide between buyer and seller, but the curve is so backwardated. Pretty much everybody's using about an $80 price deck. So if spot prices are 93, 92, 95, we're all using, it's moved up. It used to be 65, 75, and it's around 80, 85 now. So you saw Tourmaline announce their acquisition of Rising Star at about 2.5 times cash flow. So you're seeing some deals get done, but I think it's the public companies are trading at low multiples. Like Surge, we're at 2 times cash flow, 2.5, not even 2.5, 2 times. So it's hard for me to go pay 3 or 4 times, which you normally would see in the market. So I think the public market is the governor on the expectations of private guys. And we do see there's still a lot of stuff out there, but you saw Grant get his deal done with Whitecap buying out Imperial in the Montney and Duvernay a few weeks ago. Surge, we did 2 deals in the fall to get us into Southeast Saskatchewan. I will admit those are working out better than we anticipated there, as Derek said. So yeah, I think part of our strategy is to keep looking for elite reservoirs. But guys, if we don't see them, we got a 12-year inventory. And if you say, what's your juicy tier 1 and tier 2 drilling, it's probably 6 or 7 years of juicy drilling. So we're under no pressure to do a deal. But if we do see an elite asset package, we wouldn't hesitate. But right now we don't have a deal in hand, but we're always out looking.
Okay, thanks. And then quickly, just on Southeast Saskatchewan, obviously that's worked out better than you guys had, like you said, had planned. This should be pretty additive to your reserves, I would think, this year as well. Not that you need any more reserve additions, given where you're trading at on a discount to NAV. Would you say?
Yeah, so we'll be on track with our reserve additions that we were seeing here. It's kind of, as we budgeted this year, it's pretty much the amount of drilling that we were planning on doing. So we will be getting the reserves that we had thought for those wells. Some of them are outperforming, so we'll see a little bit more on the PDP side, and then we'll be getting some additional PUD bookings associated with the great drilling we've done down there.
And does this change your split between number of wells you're drilling in Southeast Saskatchewan and Sparky, given the quicker payout in Southeast?
Yeah, for sure. That's a great question. So when I think of the remainder of this year, we will be focusing a little more on Southeast Saskatchewan. We'll be starting up a second rig in September. So we'll be drilling a few more wells down there compared to the Sparky. So in the Sparky, we've got another 15 wells planned. In Southeast Saskatchewan, we have about another close to 30 wells planned for the balance of the year. When I think into next year, it'll be a pretty balanced approach between the Sparky and Southeast Saskatchewan, with intent right now is just to have probably 1 drilling rig running in both of those areas, but have that drilling rig flat for the entire year. So it'll be balanced between those 2 areas going into 2023.
Okay. I have a few questions now from the audience. Paul, given that your success rate on every company you have built is 100% under your tenure, and that you're responsible for launching successful careers of all the people that have worked under you, do you find that you're the first call on acquisitions or companies that are looking for partners? How deep is the private company acquisition market potential for you?
Those are nice words, and thank you. But it amazes me all the time. I like to think I'm plugged in, and top firms like your old firm and Scott Haydick's old firm, I would be the first call. But it always surprises me when I find out this or that company is for sale or this asset, and I didn't know about it. It really burns me because I like to be that first call. But no, we're a darling right now, and everybody sees the Sparky, the Southeast Sask. They see 12 years of drilling. Never want to drill your bottom third. So 7-8 years of juicy drilling, the dividend, the low payout ratio, the low debt, the net asset value of $24 a share is a great prize, and then the free cash flow. When I say we're a darling, we have private codes that are literally, I won't say throwing themselves at us, by knocking on our door daily, weekly. And I just had a breakfast with CEO yesterday who's, do you think you guys would consider they're a bit smaller than us? If we rolled into you, would you? And to me, it's about asset quality. And if he doesn't have it and have our inventory, why would I do that deal? So we are a bit of a darling for all those key fundamental reasons we talked about in the presentation. So we are an early call on a lot of private code deals, but we're really picky. We're extremely picky. Technically, if we don't see 5 million barrels in place per section, meaning big oil in place on tanks under the ground, pretty simple thing. I don't want to overcomplicate it. Drilling upside, water flood upside, core area fit, operatorship, lots of drilling upside. Derek and his team and Murray By and they say no. And our A&D team's really good. So we probably turn down, I'm guessing 95% of the things we're shown don't make our hit parade. We throw them in the garbage and we start over on the next deal. So we're really choosy, as we should be. If we have a really big inventory, we shouldn't be jumping at every private co that wants to get off their position. We should be super choosy and picky because we do have, I think, the best asset quality. Yeah.
Because you can be. Yeah.
Exactly. Good point.
With the current paradigm of distributing cash flow to investors and paying down debt and applying limited capital to your asset base, is this a challenging model for a company with your large inventory? Does this payout model apply to every company, or are you more a hybrid model to be applied to a company with your potential growth, or should you be a more hybrid model? Model.
No, it's actually, and thanks to Scott for sending it, because we go a long ways back, as you do with Scott, and it's a great question. So we just spent 3 months getting ready for a big board meeting. We completed our 5-year plan, and it looks ridiculously good. And that ties to our Spruill report, our drilling inventory, every year we freshen up. Derek and his team and Murray By and our engineering team, we freshen up our type curves, and we look at our inventory critically, and we slash and burn and pick the best. So we then go to our board, and we have that's what came out of this capital allocation matrix that we showed you earlier. So we're evaluating that all the time. But when I'm trading at $9 and Spruill, my independent and an 80 flat price deck says my net asset value is $24, and I have the best free cash flow yield in the country, so says Eric Nuttall and 9 Point Partners and others, we're saying, who's paying for surge to try and grow more? And like, we have a really low base corporate decline, and we like to keep it there. We're about 25%. We even want it lower. So we're managing to keep it low. And I'd like to get back to about 20% over the next few years. Who's paying? If I'm trading at 1.5 times my NAV, which should be about $36 or $30 or even $25 a share, then people are paying up for Derek and I to stretch. And we might add a growth wedge, add 3-4% production per share growth. But in today's world, we're so undervalued, and so is, you're seeing this right up to the majors. I just read that Chevron is going to produce or grow at 3%, and Exxon, they're the only ones showing growth. Both BP and Shell are actually declining and selling assets. So we just think that right now, we can push out, if we have the best free cash flow yield, a 40% yield. So shareholders, people on this call, Do you have many other investments that are giving you a 40% yield? Well, that's what Eric Nuttall and others have said Surge has the best free cash flow yield. Saying it a different way, we're making our widgets, our barrels of oil, way more cost effectively and with way higher netbacks and profitability than other people. So if I'm pushing that out to you, do you need me to add another 2 or 3% growth and add risk or corporate decline to my low decline and make it go up? Or are you quite comfortable? I don't have many investments that are pushing me out a 40% free cash flow yield, which Surge is doing now with our dividends started, debt repayment, share buybacks. We'll add a growth wedge at some point. And I don't believe the market's paying for us or a bunch of other good companies to stretch right now. And that's what that's what's causing the problem of there's no oil on the planet. We used all of OPEC's excess until the market pays up, which it will. You saw our stock really rocket a while ago till this latest meltdown in the last few weeks. And it will this fall. I think crude's going to go way higher this fall. And Europe is at risk of a crisis, I believe, this winter.
Yes,
so we don't
already in crisis, really, right?
Exactly.
Yeah.
So no, we're comfortable that when the market pays up for us to stretch a bit, we'd add a growth wedge then. But Scott, it's a good question. And we went through it with our board and our new 5-year plan when we decided on our capital allocation matrix. Great question.
Okay, and just one other question from Scott here. How much of your inventory has potential for secondary and tertiary recovery?
Yeah, so that's a great question. Really, when you think of the entire Sparky inventory, so that's close to 500 drilling locations, that all of that inventory will have secondary recovery potential. When I think of Southeast Saskatchewan, that's another 300 drilling locations, 250 drilling locations. For the most part, that does not need water flood because it has such an active water drive. So you're going to get that.
Yeah.
But then when I think of tertiary recovery, there's obviously proven tertiary recovery that's happened in Southeast Saskatchewan with the Midale. And we have probably 80 to 100 drilling locations in the Midale that we'd in the future would see some tertiary recovery. To do that, we'll have to completely drill it up, move it to water flood, and then we would then do some tertiary CO2 recovery from that. So
that's quite a few years down the road at this point.
It would be, but when you think of our inventory, I would say really all of it has either an active water flood associated with it or has the potential to be water flooded.
Okay, and just another surrounding your asset base, just for the non-oily person out there, can you just explain why the importance of having seismic and well control? Because I think a lot of people sometimes just think it's a big pool in the ground that's contiguous, and unless you're looking at a tight shale play, it's not most conventional plays aren't true resource plays.
Sure. So that well control and seismic is absolutely critical to what we do. So what that really does for you is that you're able to delineate it and know exactly what you have there. So it helps to really de-risk what you've done. So, I'll use the Sparky as an example. So we were able to de-risk our 200 drilling locations because we have that well control. If we didn't have that well control, you wouldn't be having anywhere the COS that we're having out here. So chance of success. So then when you look forward, because we have all of that well control and then we have the data from all the wells we've drilled, it really de-risks everything that we're doing going forward. So without that well control and the seismic and just the integrated reservoir model we developed, it would add a lot more risk to what we do. But because we have that, we have a very tight distribution of the well results that we get. And we have a very, very high COS, virtually 100%.
Okay. Okay. 3 more questions here. Can you compare Surge's best HD pad economics with Montney liquid rich pad economics and that are also showing great results, i.e. CapEx time to set up, drill and complete, project IRR, which is variable from company to company, and depending on the liquids content. So it's
for sure
hard to really do a true comparison.
It is really hard to compare that. And, I can give some some numbers associated with our pad drilling, and that's not going to be comparing exactly what you have in the Montney, but those wells are going to be much deeper, much more expensive, and much greater lead times to what I'll describe here. When we think of a pad drill, let's take a 4-well pad in the Sparky. Generally, we're less than a week to drill each of those wells. So from spud to rig release of all of that, that's less than a month. And then essentially after that, we're immediately moving a frac crew on there. And then those fracs take a day or two for each of those. So you're really gone from spud to completed fracking in about 6 weeks. And then that well is turned over to production. So it's a very quick turnaround when it comes to that. And that's just with a pad drilling. And then when I think of Southeast Saskatchewan, we do not do as much pad drilling there. They're generally single wells, maybe 2 wells. And again, 5 to 6 days to drill. Because we don't frack, that well is turned over to production within the next week after that. So really, we have extremely quick turnaround times to get wells from spud to on production. Again, why we really like both of the areas that we're in.
Okay. Just 2 more questions here, and then I'm just going to cut it off, I think, because we're running out of time. Just can you touch on your hedging program? I know you guys just put some collars on in the last little while. Typically, prior to you having to put on the bad hedges because of the banks, etc. Your historical MO had been to hedge enough to protect your capital and your dividend. Can you just touch on what your hedges look like for the rest of this year and what you're looking at into next year?
Yes, and I think it is. The question is A, a good one, and B, just as you know, it's why Surge is starting to trade up is people are understanding that this year we've got about $100 million hedge loss, and that's pretty much all gone next year. So we'll get $100 million more cash flow than this year. And on page 9, you can see our cash flow at $85 goes way up in 2023. So the banks made us hedge fixed price hedges around 65, 70 this year. The worst of those is over at the end of June. We have a little bit more this quarter and a smaller amount next quarter. So all the fixed price oil hedges, they fall off dramatically this quarter, and they're done by the end of this year. So we said, well, we still want to have insurance. Think of it as an insurance policy. So we went out, and when oil was $120 a few months ago, we were able to lock in 65 US a barrel, call it a floor. And in the band, we keep a band up to $140 US a barrel. We operate in that band. So we can't go below $65 US, which Surge looks great at 55 US. At 65, we've locked in our full capital, full dividend, and we keep all the pricing upside up to $140 US a barrel. And then if it goes above 140, we lose that portion that's hedged above 140. So and that's called a costless collar. So we've taken fixed price hedges because it's a very backwardated forward curve for crude, meaning it drops off if you want to hedge it. And we said, screw that. When oil prices ran, we said, we'll do 65 by 140. That's locked in 38% of our production over the next year and a half. Actually more than a year, but little like by till the end of third quarter next year is locked in with that costless collar. And that locks in our budget, drilling budget, and our dividend. So yeah, we just decided, well, with the banks forcing us to do fixed price hedges in a wildly backwardated forward curve, we didn't think that was good business. So we're using the costless collar, and that's amazing. We could not even get close to the collar that we locked in today, because when we did it, crude was 120. Now crude's 92 or 3 or 4. So that same hedge is not there. It would be a way lesser amount on the top end. So we're thrilled to get that. Good question.
I might want to just point out to investors, one of the reasons why you had such good performance this year is because, you were a bit delayed because of the shitty hedges you had to put on. And so then that's why you were outperforming this year. And so I think we should see a similar kind of case as the rest of those ugly hedges roll off.
You bet. I agree with you.
And then just one last question from the audience. To doing acquisitions as part of your capital return. We kind of touched on this. Could you elaborate how you would measure doing an acquisition versus doing paying out a variable dividend?
Okay, that's a very good and technical question. We look at all of the capital allocation things that are on the table for us, which do include acquisitions. So dividend, special or variable dividend, growth through the drilling bit, share buybacks, where we're trading vis-a-vis our asset value, and then we look at acquisitions. So if we look at acquisitions, we want them to be accretive, but we want them to fit all those criteria. I love showing you the charts, which I don't know if they verify. I think the Sproul report verifies it, and our free cash flow yield is your empirical proof. But I want to be able to show you on the sheet that Derek and his team, Murray Bai and his engineering team, have done their work, big oil in place, high quality reservoirs where we can infill, step out, water flood, horizontals, Packers Plus technology, water floods, whatever way we can add more barrels than we paid for. I better be able to show you that type of an acquisition, or why the heck did we do it? So your question is bang on of what we look at every time we look at an acquisition. Do we say to ourselves, are we a better company to do it? And we compare it to our drilling, which we're in 2 of the top 4 plays in the country. So it's a pretty high bar. When we do an acquisition, you can rest assured it's a really good asset, because we don't need to do one for at least 5 years if we got all kinds of great tier 1, tier 2 drilling locations. So brilliant question, actually. And it actually puts Derek and me right on the horns of the dilemma with our team and our board. Does this acquisition make you better? And if it does, great, go ahead with it, or try and get it. But if it doesn't, discard it. Don't be, make sure that you stay disciplined on adding those kind of reservoirs that fit that model we showed you earlier of elite, conventional, low-risk reservoirs. That's our whole strategy. And what do they churn out? Free cash flow. They churn out free cash flow, and that's our mantra. Damn good question, frankly.
And I mean, I don't think a lot of people realize the amount of work that goes into analyzing a company when you're doing A&D. And like 90%, 99% of deals don't end up working out in the end, right? So there's a lot of variables that you have to go through, and you guys do an excellent job at it. I think we've taken a whole hour, so
no, great
I just want to leave with everyone that if you would like a one-on-one with the company, I'm happy to set that up. If you have any further questions, please contact me again at jessica@adcap.ca. And thank you guys once again for a great performance. And I'm happy for my dividends. And we'll see you soon.
You betcha. Thanks, Jeff.
Thanks.
Okay.
Take care.